Heads up, XRP might be setting up the kind of move that only shows up once every few market cycles. The kind you don't chase, the kind you either already positioned for or you end up watching from the sidelines, wondering how you missed something that was hiding in plain sight the entire time. This is infrastructure quietly snapping into place while most people are still arguing about old headlines from years ago. Let's set the scene. It's just past 1 a.m. here in Dubai. The city is humming. The air conditioning is losing its war with the heat. And I've got a half-finished espresso going cold on my desk because I can't stop refreshing one screen. The CME dashboard. And that's not something I say lightly because when futures markets start lighting up before price does, that's usually the tell. CME's brand new XRP futures contract just logged another surge in volume, and it feels less like random activity and more like the first domino tipping. I've seen this movie before. Bitcoin did this, Ethereum did this. Futures arrive quietly, institutions poke around carefully, volume builds slowly, and then one day the conversation flips from if to how big. Deja vu doesn't knock loudly. It slips in through the side door, and by the time everyone notices, positioning is already done. Before we go any further, a quick note for anyone trying to follow setups like this without getting lost in the noise. That's why XRP Insider's Elite exists. It's linked in the pinned comment below. It's a premium collection of clear documents, visuals, and videos that focus on what actually matters, how larger players tend to position, and how these patterns have played out before. Now let's keep going. If you've been on this channel longer than a couple of double espressos, I've never sugarcoated XRP's history. For years, it's been crypto's longest running soap opera. Lawsuits, regulatory drama, endless Twitter debates, and that one guy at every family gathering asking, didn't the SEC kill that coin already? XRP has lived under a cloud longer than almost any major asset in this space. That's why what's happening now matters so much. I'm watching those first CME trades settle. 50,000 XRP blocks clearing smoothly, one after another, and it feels like someone just unlocked the institutional investor cheat code. Day 1, roughly $19 million in notional volume. Day 2, another $10 million on top. Within the first week, about 1,800 contracts traded, totaling roughly $35 million. And yes, I can already hear the critics warming up. That's nothing compared to Bitcoin. True if you completely ignore the fact that this market literally did not exist before Monday. Institutions don't sprint. They don't ape in. They probe. They test. They move deliberately. And right now, XRP is being quietly invited into rooms it hasn't been allowed into before. Here's the detail most people gloss over, but Wall Street absolutely does not. CME didn't launch just one XRP futures contract. They launched two. A micro contract at 2,500 XRP and a standard contract at 50,000 XRP. That's not accidental. That's accessibility by design. It's CME saying whether you're a hedge fund intern dipping a toe in or a pension fund allocating serious size, there's a seat at the table. These contracts are cash settled. They're backed by a daily reference rate. And most importantly, they're regulated. That single word changes everything. When regulators sign off, compliance departments relax. When compliance relaxes, liquidity shows up. And suddenly the old excuse of XRP is too risky from a regulatory standpoint starts to sound outdated. Now zoom out to Washington for a second because this is where the tone really shifts. Imagine swapping out the SEC chair the way a League of Legends team swaps its top laner mid-season. One move, completely different playstyle. Enter Paul Atkins, confirmed last month after President Trump, yes, he's back, tapped him faster than most people skip YouTube ads. Atkins isn't a crypto maximalist. He's not pounding shots at conferences. But compared to Gary Gensler, he might as well be DJing in a laser suit. Within his first week, he's hosting rounds with industry leaders. More than 70 crypto ETF applications are reportedly sitting on his desk right now, including multiple bids for a spot XRP ETF. And while official decisions are rumored to be pushed toward June, the vibe changed overnight. This went from maybe someday to potentially this year. And before anyone jumps in with the classic line, ETF talk doesn't matter until the Ripple lawsuit is dead. Believe me, I've yelled that exact sentence into the void for over a year. But here's the twist. We're finally at the end game. Ripple and the SEC are actively working through revised settlement terms so Judge Torres can sign off and move on. When that gavel drops, Compliance teams across asset management firms aren't going to debate it for months. They're going to file hard. Picture BlackRock CK, Fidelity, Wisdom Tree, not making speeches, just quietly lining up like it's an iPhone launch because that's how institutions actually move when the path clears. And while the US debates, the rest of the world isn't waiting. Brazil just lapped everyone. XRP-H11, the world's first spot XRP ETF, launched on the B3 exchange. It went live and immediately started pulling in institutional demand, pension access, regulated exposure, no drama. When another major economy builds an XRP on-ramp before the SEC finishes its morning coffee, you can bet American institutions notice. Then comes the Oval Office curveball. Earlier this year, Trump signed an executive order creating a strategic Bitcoin reserve and a broader U.S. digital asset stockpile. Buried in that announcement, almost as an aside, was language about exploring additional high-velocity settlement assets. Translation: assets designed to move value fast across borders at scale. XRP sits squarely in that conversation. Think about what that actually means. This isn't retail speculation. This is geopolitical plumbing, a crypto version of the Strategic Petroleum Reserve. If the US government even hints at holding XRP as part of a broader liquidity framework, that's not just bullish, it's transformational. Now let's address the macro backdrop because skeptics love to wave it around like a red flag. Yes, but geopolitics are a mess. True, wars, sanctions, uncertainty. But even here, the tide is shifting. Ceasefire talks between Russia and Ukraine are moving from never to maybe. Reports suggest draft frameworks are on the table. If macro risk cools even slightly, capital doesn't sit on the sidelines. It flows. And when it does, it looks for assets built to move money efficiently across borders. That's XRP's wheelhouse. Here's the part most people miss. XRP isn't trying to win a meme contest. It's not fighting for attention on crypto Twitter. It's positioning itself as infrastructure, the kind of asset that doesn't care about day-to-day volatility because its demand comes from usage, not vibes. Think back to that friend who bought Apple stock after the first iPod announcement and then forgot about it. Not because they were a genius trader, but because they understood the product mattered. XRP feels like that moment. The rails have existed for years. What's new is that Wall Street is finally paying attention. Futures create liquidity. Liquidity supports ETFs. ETFs unlock retirement funds. Retirement funds bring slow, steady demand that doesn't flinch at intraday swings. That's how assets mature. And here's where the sequence starts to matter. An analyst known as J4B1 laid out what he calls the XRP domino effect. Futures listings, spot ETF approvals, institutional adoption, true price discovery. It's not speculation, it's a pattern. The same one Bitcoin and Ethereum followed. Institutional money is like a tanker ship. It takes forever to turn, but when it does, it reshapes the ocean for every smaller boat around it. Now let's stay grounded. This isn't risk-free. Volume could stall, regulators could drag their feet, Ripple could fumble the settlement at the 1-yard line. 1,380 contracts isn't a tidal wave. It's a test sip. What everyone wants to see is scale, but that's exactly why the micro contracts exist. They allow cautious players to test exposure without committing massive capital. Nobody loads up a plate without tasting the food first. And here's another key detail that matters far more than most people realize. CME's reference rate averages XRP prices across multiple exchanges at 50 new UTC daily. That standardization is huge. It removes the Wild West pricing problem. It gives fund managers a benchmark that passes compliance checks. Combined with XRP's near-instant settlement, you're suddenly talking about financial infrastructure, robust enough for banks and central institutions, not just traders. Atkins himself hasn't been shy about the tone shift. In his first SEC address, he explicitly said, "Regulation should foster innovation, not push it offshore." That single sentence sent ripples through corporate legal departments. Internal memos don't say avoid XRP anymore. They say conduct preliminary risk assessment. And while that's happening in the US, XRP is quietly collecting passports globally. Latin American payment firms are running on-demand liquidity pilots. European banks are building ISO 2022 bridges that integrate XRP directly into their messaging systems. Asian financial institutions are exploring whether XRP's liquidity hubs can outperform decades-old SWIFT corridors. This isn't loud, it's methodical. Now connect the dots. CME futures a pro-crypto SEC shift. Lawsuit settlement nearing. Brazil's spot ETF proving demand. Macro risk easing. Strategic digital asset conversations at the federal level. That's not one catalyst, that's a sequence. And sequences are how real moves happen. People love to joke about the XRP army promising moon landing since 2018. Fair. But every market has moments where the punchline becomes reality. When probabilities shift, narratives follow. I'm not telling you to go Allen. I'm saying widen your lens. Crypto isn't just about hype anymore. It's about liquidity rails, compliance, and global settlement efficiency. XRP's recent milestones hit those metrics directly. Now consider this thought experiment. If institutions allocate just 0.25%, 25% of their $2 trillion alternative asset pool into XRP post ETF, that's $5 billion in new demand. At current circulating supply, that alone moves price significantly. Add real settlement demand, add strategic reserves, add remittance corridors abandoning inefficient Nostro accounts, and suddenly the models start looking aggressive. Earlier tonight, I scrolled through my own old tweets, old videos, times I said XRP would stay boring until the lawsuit ended. I stand by that take until now because clarity is finally showing up, and markets don't reward loyalty to old opinions. They reward adaptation. So keep watching the CME volumes. Watch how institutions scale. And understand this, what's unfolding here isn't a spike. It's a structure forming. And once structures lock in, price tends to follow faster than most people expect. Here's where most people misread what's happening. They keep staring at the price chart, waiting for fireworks when the real signal is happening off chart. Futures volume isn't about today's candle. It's about permission. It's about whether large players are allowed to even touch the asset. And for the first time in XRP's history, that answer is quietly becoming yes. Think about how asset managers actually operate. They don't wake up one morning and decide to love a token. They work backwards from constraints. Is it regulated? Is there a reference rate? Is there a derivatives market to hedge exposure? Can we justify it to compliance? Can we size in gradually without moving the market against ourselves? CME futures check all of those boxes. That's why they matter more than a flashy price spike ever could. Now layer on what happens next in that sequence. Futures don't exist in a vacuum. They attract market makers. Market makers tighten spreads. Tighter spreads attract more volume. More volume stabilizes price behavior. Stable price behavior is exactly what ETF issuers need to make their case. This is why Bitcoin's ETF approval didn't come out of nowhere. It was built on years of futures infrastructure that most retail investors ignored at the time. XRP is now walking that same road, just compressed. Another thing that doesn't get talked about enough is optionality. Futures give institutions flexibility. They can hedge spot exposure. They can run relative value trades. They can express bullish or bearish views without custody risk. That flexibility increases participation even from players who aren't outright bullish yet. Ironically, that skepticism still adds liquidity, and liquidity is the fuel. Now let's zoom in on the lawsuit one more time because this is the emotional anchor for a lot of people. The reason XRP has felt stuck for years isn't because demand didn't exist. It's because demand couldn't legally express itself at scale in the US. The moment that uncertainty is removed, you don't get a gradual shift in narrative. You get a snap. Compliance departments don't debate ideology. They respond to clarity. If the settlement lands cleanly, XRP goes from special case to approved asset class candidate overnight. And that's not hype. That's how internal checklists work. At that point, ETF filings stop being speculative headlines and start becoming operational timelines. Custodians finalize frameworks. Authorized participants step in. Liquidity providers ramp up. None of this is loud, but it's relentless. Now let's talk about supply dynamics because this is where a lot of surface level takes fall apart. People see XRP's total supply and immediately dismiss upside without doing the math properly. What matters isn't total supply. It's liquid supply versus demand at the margin. A significant portion of XRP is either locked, held long-term, or functionally illiquid for trading. Meanwhile, new institutional demand doesn't need to buy all the supply. It just needs to overwhelm what's actually available for sale. That's how repricing happens, not because everyone buys, but because sellers disappear. Add to that the fact that XRP's utility demand doesn't behave like speculative demand. Institutions using XRP for settlement aren't flipping it, they're cycling it. That creates a different pressure profile entirely. Less churn, less panic selling, more consistent throughput. And that's where the global angle becomes impossible to ignore. While US regulators argue international adoption keeps creeping forward, cross-border payment corridors don't care about Twitter debates. They care about speed, cost, and reliability. XRP continues to score well on all three. ISO 2022 alignment isn't a buzzword, it's plumbing. And once banks build around a standard, they don't rip it out lightly. What you're seeing now is convergence, regulatory clarity, institutional access, and real-world utility moving closer together than they ever have for XRP. That's why this moment feels different, not louder. Different. Now let's ground this in behavior, not theory. Watch what happens if XRP starts holding higher lows while futures volume continues to climb. That combination is deadly in the best possible way. It signals accumulation without emotional excess. It's the opposite of a blow-off top. It's a base forming under the surface. Retail tends to arrive late to those moves, not because they're dumb, but because they're trained to react to price, not structure. Institutions do the opposite. They position first and let price confirm later. That's why the early stages always feel boring until they're suddenly not. This is not financial advice. And here's the part most people underestimate. Once XRP is allowed, it doesn't just compete with other cryptocurrencies, it competes with legacy systems. Nostro and Vistro accounts, trapped capital, slow settlement. Those inefficiencies are massive. Even marginal displacement creates outsized demand. You don't need every bank to adopt XRP. You need a few major corridors to flip. Once that happens, others follow, not out of ideology, but out of necessity. Now circle back to the US strategic angle for a moment. Even the hint that digital assets beyond Bitcoin are being evaluated at a national level reframes the conversation entirely. It signals that crypto is no longer being treated as a speculative sideshow, but as infrastructure. And infrastructure assets get valued differently. They get patience, they get protection, they get scale. This is why comparing XRP's potential move to past cycles misses the point. This isn't 2017. This isn't even 2021. The players are different. The motivations are different. And the rails are finally being laid correctly. Does that mean straight up forever? Of course not. Volatility doesn't disappear. Pullbacks happen. Headlines shift. But the floor changes. And when the floor changes, long-term outcomes change with it. And what's next looks increasingly institutional. So here's how to think about this going forward. Practically stop asking, is XRP going to moon tomorrow? Start asking, what would steady institutional adoption look like over the next 6 to 18 months? That question leads to very different decisions. Watch futures volume trends, not one-day spikes. Watch regulatory language, not Twitter outrage. Watch who's building, not who's shouting. That's how you stay ahead of moves that feel obvious in hindsight. Because if there's one pattern that repeats in every market cycle, it's this. The biggest gains come from understanding structure before price reflects it. And right now, XRP's structure is quietly transforming. Before we wrap this up, let me make this practical. If you don't want to chase headlines or stitch this together on your own at 2 a.m., that's exactly why XRP Insiders Elite exists. It's linked in the pinned comment below. Inside, you get exclusive insider alerts, clear documents, visual breakdowns, and videos that break down the exact frameworks the top 1% use to build generational wealth, guided by a crypto expert with over 10 years of real market experience. Get clarity before the crowd so you're positioned early, not reacting late. That's it for now. Keep your eyes on the infrastructure. That's where the real story is being written. Bitcoin did this, Ethereum did this. Futures arrive quietly. Institutions poke around carefully. Volume builds slowly. And then one day the conversation flips from if to how big. Deja vu doesn't knock loudly. It slips in through the side door, and by the time everyone notices, positioning is already done. Before we go any further, a quick note for anyone trying to follow setups like this without getting lost in the noise. That's why XRP Insiders Elite exists. It's linked in the pinned comment below. It's a premium collection of clear documents, visuals, and videos that focus on what actually matters. how larger players tend to position, and how these patterns have played out before. Now let's keep going. If you've been on this channel longer than a couple of double espressos, I've never sugarcoated XRP's history.